that we were going to get a big spike higher in oil prices. And, in that world of short-termism, you can recognize that we then got a spike higher in prices. So the Nash equilibrium, comes from that big drive there because it then ties up that drive. Nash equilibrium changes direction. And we can see that we get a little buy trade in there, and it is a 12 up to a 27. It's at 30. It's only a 20-tick move, but it's still $200 of high probability trading into that as a narrative, in a fast money moving way. And as I said, the bigger the gap, the better the opportunity. Here's a good example of what we mean by that. You can see that the Nash equilibrium suggests that we should be really pushing hard to the top edges here. And, we have room probably still to take advantage of that Nash equilibrium. And we still were able to make some additional money on that bit of business. We're not comparing like with like across these candles here. That sells came in, then the buys came in, but that divergence is visible to everybody. And there's a real money chance that you could have maybe worked into some sell side business there and around about 50s, traded back down to 35 for another 15 ticks or another $150. Into this current trade here, you can see that we get a very strong Nash reversal coming in. And with that strong Nash reversal, you're looking to try and get those discount prices into your account and maybe pick up some of those types of trades. That might have been a nice easy money scalp trade. So this really is scalping process. It's not got swing value at all. It has zero swing value, in fact. But nonetheless, inside the world of scalping, you can look for yourself and you can see a lot of trades that have some value and some trades that simply have no value at all. You're looking for divergences. You're looking for individual candle reversals. There's not that many. The bigger the gap between the A and the B part, right? So this is the A and the B part of that equation. The bigger the gap between those ideas, the bigger the opportunity to stay short, right? So when we see that, we can recognize, for example, here that there's a very high probability that that sell is going to stay short. And see, obviously, that from that price there at 13s, it drops really nicely down to 10s, or zeros rather. And we got a nice sell side continuation. In this area here, you can see that there's a big gap difference. So that tells me that according to Nash calculation, that this is going to be a sell trade here. And the very next candle, we then get a big sell trade coming, a big sell trade in relative value terms, of course. We then get the sell trade coming in. So when we see these in the short term, you can start recognizing, the type of idea we're trying to go after. Here, we recognize that Nash is kicking off big style to the upside. And if Nash is kicking off big style to the upside, if I buy into that story, probably I've got a better room to make some money. You can see a Nash sell here, nice easy money. The Nash buy here, nice easy money. This one's a diverging storyline. Remember, you've got to be careful when these are the same, but when the gap opens up, we now have space to roll this trade. Space to roll this trade a little bit. So, we can obviously look at those types of ideas. Well, but as I said, not convinced that it has value, but, still looking at it. You can see at the moment, this would still be a buy trade at the moment. It still looks as if we're going higher. And of course, the idea is that we might be trying to test back into the swing high here in the short term. But, it's a Nash calculation. Of course, that's all it is. It's a Nash calculation. It's not looking at swing high against swing high or swing low against a new swing low over here. It's simply what's happening in this current auction and only this current auction. And as I said, the bigger the gap, you can see there's a very big gap here, but that's because the price did move. So that was a fair value Nash equilibrium trade, right? That was fair value. So obviously at the end of that candle, there was nothing to do except recognize that it was a fair value Nash candle. So your concept is, well, if that's a fair value buy, there might be an opportunity for me to buy that discount. And you can see that this B part still maintained bullishness, which gave you a diverging story. So you could have came back in there and says, give me some of that. Well, that divergence doesn't work on this candle. So that's not going to be a buy and a pullback. Right? You see the difference? The diverging storyline here, that was still diverging buy side. So that's still a buy trade. This is not a diverging buy story here. So this is not a buy trade. Okay, so no luck on that one. The gap is very tight here. So this could go in any direction at this point, because obviously that's diverging at the high price. So that takes away some of the upside room. So obviously, if we're going to stay with this buy trade, we would like to see that Nash forecast being bullish. Well, the Nash forecast still isn't bullish, is it? It's still bearish. So with the Nash forecast on this still bearish, then this is obviously a bit of a challenge here. So if you're a scalper, it would be a good idea on these upticks just to bag some of your monies and say, you know what, I'm going to scalp a few $100s out of that bit of business there and just be happy with my little scalp sell trade there. Now you can see that the Nash is now quite actively bearish. And obviously with the Nash now actively bearish, we now look at that and say, well, if I could get a little bit of pullback here, there might be a nice opportunity for me to work in this. Because this is forecasting, according to Nash, that the oil price is now bearish. The market maker is bearish. The price will start selling off. And, well, the price just started to sell off there. So the Nash was correct on this. This is a fair value Nash read on that sell coming in, right? So we were right about that profit take. And yet Nash was able to tell us, the Nash equilibrium was able to tell us that that was correct. You can see what's happened since then. Look at that. You couldn't make this up, could you? It's on the right-hand edge. So on the right-hand edge, it's just, look at that, guys. It's went from 52s to 44s in 60 seconds. So, you know, as I said, I'm not sure that it's got value. I think it's got value if you're a crazy scalper, if you're a gunslinger and you love your scalping and you want to get that type of execution skill getting into your trading. You know, I think it's got a very high degree of value in it because that trade now, that sell trade at 52 is now trading at 41s. So that's $100 you could have made on the scalp trade there. Nash equilibrium still bearish. And as I said, you've just made $100 on the scalp into the prior low there. So that was pretty damn rootin' tootin' good, wasn't it? So that was a live shout out into that top edge exit for that buy trade. So very, very nice indeed. But as I said, not sure. You know, the problem is, you know, the idea is, of course, you know, if you're not trading in the futures markets, then this isn't going to be, something you're going to look at and say this is going to work for you because you're going to pay the spreads on CFDs. It's too short term. It's not going to be the right type of trade for you in that type of environment. However, you know, if you are in the futures markets and you can work those spreads in your favor, then of course this is a very nice way to do 100, 200, 300 trades a day if you wanted to. And obviously doing 200, 300 trades a day if you wanted to is going to cost a lot of money, but you're obviously going to be able to make your $50, your $100, your $200, and occasionally hold one of those trades for one of the big swings and see what happens next. You know, so occasionally you might get a big trade coming from it. The other thing, of course, is that it can sit inside of the max process, can't it? You know, you can obviously use this in line with the max process, looking for that same storyline coming in from that market maker story. And then, you know, which obviously meant that you were predominantly playing at the moment on that oil trade as a buyer on dips. So when you saw the Nash starting to forecast a buy on dips, do you see the problem? Do you see the possibilities, right? So the possibilities using Max and Nash simultaneously, you can see just in here, you can see what happened. You can see that the market maker is in charge. You see that? So we've got an F3 buy trade setting up here, yeah? You've got an F3 buy trade here. Do you agree? We're above the zero. We've got an F3 buy trade. And then the Nash forecasts a buy trade on a down candle. You see it? So Nash starts to forecast a buy trade on a down candle in an F3 environment. So in that environment, you now have a very strong buy level. And obviously, based on a very strong buy level, it's just a pity this didn't forecast a buy trade there, but you know, we know about this price level. Then, of course, that gives you that confidence to be long into that marketplace. You know, and that's when we start thinking about the possibility that there is a real value to this. Because if you can pinpoint that buy trade at 41s, it just traded 54. You know, I mean, that's a $100 profit right there in 4 or 5 minutes. I mean, do one of those trades a day, you've got a career as a trader, haven't you? Just one of those trades a day, you've got a career as a trader. You know, because this trade tomorrow might have 2 contracts on it, and the day after that, you might go up to 3. The day after that, you might go up to 4, and the day after that, you might go up to 5. You know, and all of a sudden you're finding that one trade a day where the Nash lines up in line with your market maker prediction, in line with your value prediction, and you start whacking a great big winner into the markets and walloping this trade level. And if you did come back in again at 41s, it's obviously just spiked higher now to 62s. You've now just made a killing on that buy trade that was in line with was in line perfectly with the Max and the Nash trade idea. So, you know, when you start thinking about these as possibilities, the possibilities become almost endless. You know, the right trade, the right price, the right areas, the exact moment when this becomes a thing. Because at that stage there, it's just parallel shifting. So we don't know where the buy is going to come in. But Nash knows where the buy is going to come in, because Nash isn't based on frequencies, is it? Nash is not based on frequencies. Nash is based on game theory. So this is not based on the frequency that's coming in. This is based on game theory about what did come in. The current candle versus the prior candle versus the finished current candle. Right? So it goes backwards and forwards and makes a calculation, and then suddenly we go from a bearish candle here to a bullish candle here, and on a down candle we stay bullish, giving us this idea that we can now buy that discount and make some very nice money in line with the F3 setup. And that is when we make the massive breakthrough in terms of these stories, isn't it? Because we can see that this becomes a real money trade level, and we can start using it perhaps to get some swing trade ideas. We know that this has a real price value available to us now. And obviously, if we got lucky and we decided to come back in again here, then of course you've just seen a brilliant buy trade for 25 ticks. Now, of course, this still looks good, but Nash is now suggesting that this is a top edge, right? So Nash game theory now suggests that that top edge is in. So what are we going to do there? We book our monies, right? So we book our money at that stage at 63s, and sure enough, the price has now dropped to 57s. And obviously, if you'd got in at 41s, then that's a nice 22-tick profit on that bit of business, just the same way as you made 10 ticks on this one. So that's you made $300 profit on a 1-minute chart. On a one lot, $300 profit. Well, that's pretty good. That's a nice way to make a living, isn't it? You know, so again, it might look complicated, but when you zoom in like this, it doesn't look, I mean, when we zoom out, it becomes a little bit almost impossible to figure out what the hell's happening anywhere, right? But when we zoom in, we can see the individual candles that are discounted. We can see the stories. Now, this one's going to be a problem because it doesn't discount, but you might say, well, I don't have to buy it on the way down. I can buy it on the way back up here. I can buy it when it comes back away from that rejection and get involved in the last part of the leg higher, which is worth about $200. It's still a $300 winning sensation, isn't it? And then you wait for the next opportunity to deal, don't you? Anyway, that's where we're at, guys.